Thank you, Shirley and Chloe, for that excellent introduction to the webinar and the study, and also for the financial support from ILRI and Gatsby Africa that allowed for this study and webinar to take place. A quick look at the agenda for the first presentation. Arjun Bhupal of Gatsby Africa's livestock team and I will take you through results and takeaways from the Kenya Livestock Investor Landscape Study and share conclusions and a call to action. The presentation will run for around 30 minutes, and then we will have an opportunity for a live Q&A. Although we'll be answering live, please put your questions for the Q&A using the Zoom Q&A function. So why did we do this study? Livestock is critical in Kenya, contributing to livelihoods of more than 25 million people, supporting nutrition and driving economic growth. The sector, which we define as including dairy, poultry, meat, and eggs, pork, beef, and small ruminants, contributes 42% of agricultural GDP. This means livestock is very important to current and future economic growth in the country. And the sector has huge potential. By 2030, demand for livestock products in Kenya is expected to increase by 40 to 50%. You may already be seeing increased demand for your products, and you may be working on how to grow your business to capture it. Despite these facts, livestock remains one of the most underfunded segments within the country's agricultural sector. Kenya is generally a hotbed for investment. Agriculture investments are growing, yet livestock still obtains a small fraction of this. Since 2015, investors have made more than 100 deals totaling almost $500 million in agriculture in Kenya, but less than 10% of these deals were in livestock. In addition, agriculture as a whole receives less than 3% of commercial lending, and similar to the overall investment trends that I just described, livestock also receives only a small fraction of this. We know that for businesses currently getting most of their finance from sources such as family and friends, overdraft facilities, or local bank loans with high interest rates, obtaining finance from other investors can help you grow and scale your business. Thus, we undertook this study to see how more investment can be unlocked for the livestock sector. Our study looked at apologies, I'm having some PowerPoint functionality issues. All right, we'll get this figured out. Sorry for that. Our study looked at three main investor types: development finance institutions, or DFIs, as they are commonly referred to, impact investors, and commercial banks operating on the national level in Kenya. I think everyone in this forum is likely familiar with and already doing some business with commercial banks such as Family Bank, Equity, and KCB. DFIs are specialized banks or subsidiaries with funding from national governments or multilateral institutions. They are, in fact, impact investors seeking to support private sector growth and innovation in developing countries, but they are sufficiently different in operations from non-DFI impact investors to separate them for this study. DFIs exist at both local and global levels and tend to have large budgets and ticket sizes and more bureaucratic structures. Impact investors are a broad category of non-bank and non-DFI investors who seek to generate measurable, beneficial social or environmental impact alongside a financial return. They have multiple sources of funding ranging from high net worth individuals to corporations, to donors, to DFIs themselves. So if you are a business, where did you get your funds to start the business, to grow the business, for day-to-day operations? We'd like to hear from you on this point. Please answer the poll on the screen. What are the main sources of finance you use for your business? Please select the top two. We'll give you a few seconds to respond and then pull up the poll. Now to see the results. It was a quick take. Hopefully people were able to respond. 1 second for that. Okay, so this actually falls out very much as we would have expected it to, with the majority getting main finance from family and friends, also bank loans, some using a line of credit. And then, interestingly, we have some that have experience with venture capital, DFIs, impact investors, angel investors, and then a little bit higher with grants. So that's excellent. We have a range, but I think everyone will benefit from this because we really will be digging into these investors who less of you have experience with. So I want to talk for a minute about our approach to the study. We started with almost 100 investors who invest in agriculture in Kenya. Then we narrowed this list to around 50 based on our assessment of their likely to invest in livestock. For both groups, we analyzed historical livestock investments and investor strategies and approaches and developed a database to record this information. Then we selected 18 investors who are actively building pipeline in Kenya with some openness to livestock investing for deep dive interviews. The interviews sought to shed light on the investors' funding mechanisms, ticket sizes, meaning how much they invest, focused livestock subsectors, and challenges experienced. This allowed us to assess, one, the level of investment opportunity for livestock investments from the different investor types, and two, the constraints to livestock investing as perceived by investors. As with any study, there are limitations to ours, and we want to be transparent about this. Our data analysis is limited to disclosed deals, meaning deals that investors share information on, such as the business invested in, the subsector of investment, the amount of investment, and/or the funding mechanism. Because of the reluctance of many investors to disclose deals, it is likely that several livestock investors and a significant number of transactions are not included in this analysis. That said, we were able to capture information on a wide range of diverse investors operating in the agriculture and livestock space. Some of you may recognize names on this slide, and maybe some of you have partners included here. By looking into the details of these investors, we generated interesting data and identified promising investors. So how many deals are we talking about? Out of the long list of 88 investors, 31 investors, or just under 40%, disclosed deals in livestock, resulting in a total of 51 deals made since 2010 that we analyzed. Debt was the funding instrument of choice by most investors in comparison to equity. And just a quick reminder on terms to ensure we are all on the same page. In an equity deal, a business raises finance by selling shares of the company. In a debt deal, a business borrows money and pays it back over a set time frame with interest. In the second presentation today, Gideon Laux will go into more detail about these different funding mechanisms. While some sectors dominated, and we'll talk more about that later, investments were made in 9 subsectors covering multiple livestock value chains and ranging throughout the supply chain from primary production to processing. In total, we looked at deals in 19 countries across the continent. And despite the intended bias on investors who cover Kenya, there was widespread representation of other countries, particularly in East, West, and Southern Africa. We did not observe a strong concentration in specific countries, which is a trend seen in other agriculture areas such as the ag tech startup space, where investments are very heavily concentrated in 2 countries, Kenya and Nigeria. Please note that commercial banks did not disclose specific livestock deals, so are not included in the quantitative data analysis. They were instead included in the interviews and qualitative analysis. So what trends can we see in the 51 deals we analyzed? DFIs have historically invested more in livestock than impact investors. Note that this makes sense because they have bigger pockets. They have much larger budgets than impact investors usually. The total amount invested in deals for which the amount was disclosed, which was 28 out of the 51 deals, is $165 million. We can just do a quick extrapolation and guess that for all the investors reviewed, maybe the total investment is more like 300 million and above. Of the 165 million total invested, DFIs had deployed 132 million, or 80% of the total analyzed. And impact investors, 33 million. More importantly, DFIs have much larger ticket sizes than impact investors, averaging over 7 million per deal, with impact investors averaging around 3 million per deal. DFIs tend to invest in larger, more established companies, while impact investors invest in a range of company sizes and stages, including early stage ventures. 2 additional trends to mention. 1, debt is the preferred funding instrument over equity by far. And 2, as mentioned previously, equity investments tend to be larger than debt investments. Note that while the data here shows only livestock deals, these same trends are also seen across crop agriculture and in other sectors as well, so no surprises here. Investments were in a range of value chains and businesses operating throughout the sector from on-farm production through processing. However, dairy and poultry received more than 50% of the deals. This reflects the fact that investors perceive lower investment risk in these value chains. Investors are concerned about the possibility of low or non-repayment of loans, much lower returns than expected, and/or businesses losing valuation or even closing. Investments may be concentrated in poultry and dairy because these sectors have, for example, larger and longer established businesses with strong revenue and more reliable consumer demand through formal marketing outlets such as supermarkets. Investors also follow each other and pile on investments in sectors and even specific businesses in which others have already invested. For some investors, the livestock sector in Africa is a black box. They don't have the detailed information they need about it to feel comfortable investing. So if they do invest, it is lower risk to invest in high-profile sectors for which information is more readily available and others are already investing. The total funding per subsector also reflects the relative size of established businesses in each subsector. Integrated livestock businesses, with the largest amount of funding by far, operate in multiple value chains from production through processing. They tend to be some of the largest and sometimes longest-standing livestock businesses in the country. Dairy is a comparatively highly structured industry, especially in East Africa, same with poultry, and the others are relatively less formal, less structured sectors. However, there is an overall positive message for businesses here. Despite some concentration, investors engage in all livestock value chains and at every point from production through processing. As industries such as beef and piggery continue to become more structured, investors are also likely to invest more. And this data isn't shown here, but it's also interesting to note that most sectors attract between 2 to 5 million on average per deal, with the exception of dairy and integrated livestock businesses, which had a larger average. Now let's dig in deeper to the data on impact investors. 21 impact investors made 33 deals, livestock deals, across 13 countries in Africa. 11 of these deals were disclosed for a total of $33 million. Deals were seen in all regions of the continent, but the East Africa region received the highest amount of funding with 50% of the total. This most likely reflects both a more developed investor ecosystem in East Africa and the existence of industries with more established supply chains and businesses. Now, here is some good news for SME livestock businesses in Kenya. In the 11 livestock deals with disclosed funding amounts made by impact investors, the average deal size was $2 million. The range was $300,000 to $14 million, but only 3 investments were over $3 million. This is right size for many SME livestock businesses in Kenya and creates space for many business types to consider impact investors for finance. Again, debt is a preferred funding instrument for impact investors. This is the case because investors obtain security through collateral. So businesses pledge some of their assets to the investor as a guarantee of repayment. And debt deals have more predictable returns and clearer exit strategies than equity. Equity is challenging for agriculture and livestock investments in Africa, in part due to a lack of promising examples of exits, which is when the equity owner sells the shares back to the business or to another investor. Similar to the overall picture for investments, impact investors invested more heavily in dairy and poultry businesses than in other industries. But at the same time, impact investors are also well diversified across livestock value chains and from production on the farm to processing. Closely mirroring the figures for the 51 investments we reviewed, dairy and poultry received more than 50% of the deals made by impact investors. Animal feed, meat processing, and beef received between 9 to 12% of the deals, with piggery and inputs and services falling at 6% or below. Of the 11 disclosed deals, poultry had the largest funding amount by far, with an average deal size of just over 5 million. Animal feed was the next highest, then piggery, followed by inputs and services, and beef at similar levels. Note that in most sectors, around 50% or more deals were disclosed. However, for dairy, only 1 out of the 9 deals was disclosed, so we expect that dairy actually falls closer to poultry in the total funding amount. Now, to get more specifically into Kenya, there were 11 livestock deals that we analyzed, 3 with disclosed funding for a total of $6 million. This was from 5 impact investors who invested in 4 subsectors, with dairy dominating, taking 3 of the 7 deals. Note again that this is historical data from 2010 to present, and we heard from a number of investors that while they continue to look at dairy, they are seeing less opportunity for themselves as the space is getting crowded. At the same time, animal feed appears to be an important and growing investment area for investors, given its importance to the overall animal growth in the livestock sector, combined with the severe challenges this industry is currently facing. So what kind of deal might an impact investor make in Kenya? Here are two examples to consider, and they are just that, examples, non-exhaustive, and they're illustrative only. On the left, we have an early stage business using innovative technology. They are producing animal feed using alternative ingredients to traditional maize and soy. Animal feed is a growing focus area here in Kenya, as I just mentioned, and investors have particularly been showing interest in alternative feed sources, given the high cost of feed and Kenya's dependence on imported raw material. So what does this mean? Companies producing black soldier fly, sorghum as a feedstock, food processing byproducts and feed formulations, climate resilient fodder, to name a few examples, may be good immediate candidates for investment. This company can tell an impact narrative around climate, the environment, and smallholder farmers. They require $500,000 for startup and working capital. Keywords: early stage, proven business model, audited financial statements, innovation, alternative feed, impact. On the right, we have a more traditional company seeking to introduce a new product line that has a strong impact focus for smallholder farmers. They are adding a dual purpose breed to their production line, putting in a parent stock farm, expanding the hatchery, and developing a new distribution model to reach last mile customers. This company can tell an impact narrative around smallholder farmers, women, and nutrition. They require $3 to $5 million for capital expenses and working capital. Keywords: mature company, proven track record, audited financial statements, new product line, impact. There are other business types that can fit these similar models. Do you have one? Your business might be ready for investment by an impact investor. Our main takeaway: impact investors can be a good investor group for many SME livestock businesses in Kenya and across Africa because they offer right-size investments of less than $3 million. So far, we have seen investments in poultry, dairy, animal feed, and meat processing, but impact investors are open to diversifying, and they can invest in all the value chain levels, ranging from primary production all the way through to processing. They mostly invest through debt, but if you want equity, there are some offering this as well. The number one impact measure across the board was impact for smallholder farmers or pastoralists, so your business model must clearly deliver this to be considered by most impact investors. Environmental sustainability and social inclusion are also priorities, but they tend to come after impact for smallholders. One of the big constraints with this type of investor is that they tend to spread their investments across multiple countries and make a limited number of deals in a year. In other words, they are often, but not always, fairly small operations. You need to target investors who are building pipeline in Kenya now. Here are 12 impact investors actively building pipeline in Kenya with openness to livestock investments. This group of investors has a combined broad opportunity profile that may fit many different types of livestock businesses in Kenya. They target ticket sizes, so the amount of money that they will give in a deal, ranging from $50,000 to $15 million, with most falling less than $3 million. The investors cover from early to growth stage businesses, all require a proven track record and a strong business model. Some have invested in livestock in the past, some have not. Some provide technical support, some do not. Some are broadly open to livestock investment, some have target subsectors. Jenga Capital, for example, showed a particular interest in actors operating at the distribution level, particularly around the cold chain. Rabo and Finca need a strong smallholder impact, but are otherwise livestock subsector agnostic. Incofen is open to cattle, poultry in litter, not in cages, and dairy. AgVenture is looking for tech investments. We will share more detailed information about these and other investors in the post-webinar document that will circulate to all of you participating today. This should get you started in your research of determining who might be a good investor for your business. Please don't be tempted to skip the rest of the webinar and start cold calling these investors. That won't work. And Gideon will explain why that is not a good approach in his presentation later today, and he'll give you some tips on what to do instead. Now I will turn it over to Arjun from Gatsby to finish up the presentation.
Hi, everyone. Thank you, Kristen. Yeah, sorry, everyone, just trying to figure out the technology here. Now, hi, everyone, and hello to everyone on the call, and thank you for making the time to be with us today. I know there was a lot of content to go through. Bear with us. I'm going to cover another few sections of the report we did. In this next section, I cover DFIs, development finance institutions. These can be global DFIs, such as the World Bank's IFC or Finland's FinFund, or they can also be local DFIs such as Kenya's KDC, Kenya Development Corporation. What we did is we looked at DFI investments over the past 10 years or so, and we found there were 17 deals that were disclosed. These totaled 132 million. And similar to the trend we saw in impact investors, these are spread across the continent. But these deals tend to be much larger. For example, Zambeef in Zambia, chicken in Ethiopia, fan milk in Ghana. These are big, big investments, much larger than what we saw with impact investors. Again, similar to impact. Sorry. Sorry, my computer unmuted me. I hope that didn't scare people too much. Yeah, but DFI is similar to impact investors. Debt is the preferred funding instrument. 85% of disclosed deals were debt, but when equity investments are made, they tend to be much larger, on average twice as large. DFIs also tend to prefer more structured value chains and larger businesses. Dairy, poultry, and integrated livestock businesses tended to attract the most funding, and this includes large integrated beef companies like Zambeef. It's important to distinguish global DFIs from local DFIs. Their investment approaches are very different. Global DFIs tend to offer opportunities for larger investment needs, typically businesses needing $5 to $10 million or more. Although we're seeing a trend where some global DFIs are setting up specialized funds through which they can make smaller, riskier investments. Another trend we're seeing is that ESG, or environmental, social, governance issues, are becoming increasingly important for global DFIs. So these are issues related to carbon emissions, waste management, health and safety. And DFIs expect companies to have policies and practices in place to manage these issues. On the other hand, local DFIs, such as Kenya Development Corporation, can make much smaller investments. And often they have products that are tailored for specific subsectors in the country they operate in. They also tend to have higher risk appetites than these global DFIs or commercial banks. What could illustrative investments look like? We asked a global DFI operating in Kenya, and they said, as an example, they would consider a large poultry company that needed 10 million or more, but a company that had very strong biosecurity and animal health policies and capabilities to manage these risks. And these are often mature companies with at least 3-year audited financial statements. On the other hand, local DFIs can make much smaller loans. For example, a $50 million working capital loan to a feedlot. In most cases, local DFIs would look at the experience of the business owner and most often would require some form of collateral, for example, land ownership. We thought it would be useful to talk a little bit about a new program that's been launched in Kenya that might be relevant to many of the businesses on the call today. This is funded by the World Bank and implemented by KDC. And the program is called AgThrive, and it has $40 million to be invested in livestock businesses. And this could be across multiple value chains, so meat, dairy, leather, feed and fodder. And investment sizes could be quite small, from 2 million shillings all the way up to 1 billion shillings. And AgThrive is going to be lending money on concessional terms, so less than 10%. And really the aim is to try and get the sector to grow and to demonstrate that livestock is a good and commercial sector to invest in. So what sort of businesses is AgThrive looking for when they apply? They're looking for registered business entities with certificates of incorporation and tax compliance certificates. They're looking for strong business plans and financial projections with underlying assumptions that are robust. They want to see specifics on what the money is going to be used for and how that's going to drive business growth. And finally, they're looking for environmental performance. So indication that the companies are managing issues around water use, for example, or waste management. And what AgThrive has found so far is that often companies are managing environmental performance, but aren't tracking it and aren't able to communicate to them. They've also found that a lot of the business plans that are coming to them are weak, and they have to spend a lot of time working with businesses to strengthen them. So these are really important things for businesses to get right when they're approaching investors of any kind. So that was a really quick overview of DFIs. In this next section, I'll talk about commercial banks. I'm sure pretty much every business on this call has had extensive experience with commercial banks, so we'll go through this quite quickly. I mean, fair to say that the level of investment into livestock in Kenya is low from commercial banks. And this is a message we've heard from many of the businesses we've been talking to. Although it is fair to say that the financial services sector in Kenya is very well developed in a busy space, but there are only a few banks specifically targeting the livestock sector. Banks in general are very reluctant to share and disclose information, so it's difficult to know exactly how much investment was made into the livestock sector, and also difficult to know how many livestock investment opportunities came to banks that weren't invested in. But we interviewed 4 banks just to get a sense of the landscape and understand what the opportunity was for business. So this was Family, Co-op, KCB, and Equity. But there are many other banks that are exploring the opportunity in the ag sector. So this could be an exciting space for businesses to look at. So what did we find by talking to these banks? I think fair to say that there's a big opportunity out there. Banks have a lot of capital that they want to deploy. And the banks we spoke to all had targets to increase investment in agriculture and livestock specifically. There are also many of the banks are tailoring their products for specific businesses and business models. For example, working capital products for feedlots, quite specific. And we're also seeing that some banks like KCB, through the foundation, is providing technical assistance or advice to companies on issues around governance, feed regimes, as well as potentially providing grants for infrastructure investment. So that's all very positive. But there are constraints that are preventing banks from lending more. Banks in general see the agricultural sector as very risky, and some value chains are less well understood by them and therefore seen as even more risky. And what this means is that interest rates are high and collateral needs are high, and this prevents businesses from accessing loans easily. We have seen some examples of where banks have partnered with donors to buy down risk and have managed to lend more. But in general, the constraints are holding banks back. But I think with the massive opportunity, if some of these constraints can be addressed, it could be quite transformative for livestock businesses in Kenya. So a difficult challenge possibly, but a massive opportunity there. I won't spend too much time on this. I'm sure businesses have spoken to banks a lot, but here are examples of potential propositions. A bank could loan to livestock producers that are selling to an anchor off-taker, which then guarantees offtake and gives the bank some guarantee. And this could be, for example, to dairy farmers that are supplying to a large milk processor, or ranches that are supplying to a meat processor. Another type of example could be a $3 million investment in a butchery for new value addition machinery. In this last section, we wanted to highlight a few solutions that we think could help investors invest more in livestock businesses. Again, I think worth iterating that there's a big positive. Investors are all looking for good opportunities and are struggling to find them. So there's no shortage of capital. And there is an investor out there for every livestock business type. The investors with different risk profiles who can do different ticket sizes, and pretty much any value chain can attract funding. Although we've seen some value chains are perceived to be less risky and therefore at the moment find it easier to attract investment. But investors did share a lot of concerns that are holding them back from investing more in livestock. I'll go through some of these. And yeah, I won't spend too much time on this. There's a lot of content here. But something we heard from all investors is that the informality in the sector and lack of structured offtake markets makes them nervous. So without formal contracts and predictable pricing mechanisms, investors are nervous that they might lose money. We heard from one investor that they pulled out of a poultry investment in Rwanda because the end market was so volatile and unstructured. Another risk they highlighted was that at the primary production level, to do with disease, weather, cattle theft, and this makes them very nervous. And some of the investors also didn't have the confidence that companies have the capabilities to manage these risks well. Traceability was also brought up by a lot of investors. Without traceability, investors felt they couldn't use livestock as collateral, and they felt that livestock businesses wouldn't be able to access more lucrative export markets, which then made those businesses less attractive for them to invest in. Investors also complained that they just weren't seeing livestock investment opportunities. One investor told us that out of all the agricultural deals that he saw, only 10% were livestock. And even then, most of them were in dairy and poultry. So there does seem to be a gap where the businesses looking for investment and the investors looking to invest, but the investors just aren't seeing those opportunities. And finally, investors complain that often businesses don't come to them investment ready without strong business plans, financial models, audited statements. So what can businesses do to help investors and allay some of their concerns? So there are a few ideas here. Businesses can definitely formalize their payment systems through a bank, which will give investors confidence. Where possible, businesses should enter into contractual arrangements. Again, something that gives investors confidence. To manage risks at the primary production levels, businesses should understand the risks in their industry and should be able to speak knowledgeably about these to investors and indicate what they're doing to mitigate these risks. For example, implementing an industry standard vaccination and quarantine protocol. And finally, next, businesses can be a little more targeted in the types of investors they reach out to, doing their research beforehand, so they're aligning their needs to the investor criteria. And businesses can do more to make themselves investment ready by developing strong business plans, having their financial projections clear, having an impact narrative. And businesses could consider hiring a business advisory firm that can help them identify investors and talk to investors. But it's not all up to businesses. We feel that there are other organizations like the government, like development agencies, donors, and investors themselves that can do a lot to help businesses and help investment flow into the sector. For example, development practitioners can work with businesses to test new models that link producers and off-takers in more formal contractual ways. They can also provide advice to companies on how to manage their production risks and to build the capabilities of these businesses. Government can play a very important role in looking at national and county level traceability systems. We've seen in Namibia this made a massive difference to the sector, and through that, businesses were able to access markets in the US and the EU. There's a lot donors, investors, commercial banks, and others can do to make businesses investment ready and to create pipelines. An example would be a very dedicated livestock accelerator program that supported young early stage companies. We've seen accelerators in other sectors, but not in livestock yet. Investors can also do a lot in terms of educating themselves on different value chains and the risks and how they can mitigate against them, and can invest in pipeline building and business development in the way that KCB Foundation does for KCB. You could also have a very dedicated livestock investment fund, which brings together impact-oriented and commercial investors to provide affordable financing to the livestock sector. And donors can also do a lot in terms of buying down the risk for investors through, for example, loan guarantees. So I realize I've gone through a lot here, and these are just some ideas we had for solutions that could help investment into the sector. I think at this point, we'd be very keen to hear from you. Are there solutions or ideas that you think would be interesting for Kenya to try that could help investment into the sector? We'll leave this poll up for about 45 seconds to a minute. We're really keen to hear your ideas. And following this poll, we'll go straight to the Q&A.
Great. Thanks everyone who's filling out the poll. So if you're a business and you haven't had a chance yet, please take a look at the poll that popped up in the Zoom and share with us what solutions have been most effective for you in unlocking finance for your business. And then we want to continue the conversation for another 5 minutes with Arjun and Kristen. It's been great to see all the questions that are coming in. And so we've gone ahead and pulled out some themes. One important one, which is a hot topic for all of us, is how do we balance the need for investment with the concerns that we see emerging from livestock industry elsewhere around animal welfare, climate change, environmental concerns. So how are we thinking those things through? If I can ask Kristen to respond.
Sure. I think from our perspective, what's important is that in Kenya, because of the importance of livestock for many livestock producers, and the importance in the economy, and also the importance for nutrition, that we rise to the occasion and meet that demand growth and capture that opportunity now. And that one way to do it, and we talked about this a little bit with the impact investors in particular, is investing in innovation that can drive livestock production to being more climate adaptive. And that those are the kinds of investments that we want to identify and bring forward also to impact investors, so that we need to meet the demand growth. We need the livestock sector to grow. Let's figure out ways that we can move it forward sustainably. I think the other part of that question is around, are DFIs ever going to invest in these small companies? And the answer is no, probably not. And I think that's what we were trying to say in our presentation, that the bigger opportunities are really from impact investors. And then some of the funds or the other, the impact funds that DFI set up, those would be the place to look for that. A large scale DFI that wants to make a $10 to $20 million plus investment is going to have really stringent ESG requirements, and it's going to be very difficult for a small company to meet those. And we acknowledge that, and we look for other opportunities then for investment.
Thanks, Kristen. Arjun, do you have anything to add on thoughts of investing in livestock sector growth?
In relation to climate change?
Yes.
Yeah. I think just to add to what Kristen said, I think it's important that as we're developing the livestock sector in Kenya, that we don't adopt unsustainable models in other parts of the world that have given livestock a bad reputation.
Great. No, thanks, Arjun. A set of other questions building off that is around the different types of finance that are appropriate for different types of livestock businesses. So there are quite a few questions that came up around smaller scale producers, around pastoralist producers. Are the DFIs and impact investors that we're presenting in this research appropriate for them? Where are opportunities in financing these other kinds of businesses? And I think the research started to touch on that and talking about national banks, but is there anything else you'd like to add?
So just quickly, and then over to you, Arjun. I mean, it's true that for the type of investors we're looking at, we did see investments that were down to $50,000, for example, but you do need to be able to absorb, usually over $300,000, to achieve funding through some of these investors. And you need to have a strong track record. You need to have a bank account that where your payments are passing through. You need to have some of these formal structures in place to even sort of entertain some of these. On the other hand, if you are such a small business, you can turn to local banks, M-Pesa, and other mechanisms to get finance. But you're correct. For these types of impact investors and DFIs, they do require some more structures to be in place and sort of a minimum investment amount of $200,000 to $300,000.
Great, thanks, Kristen. Arjun, did you want to add any?
Yeah, I mean, I'd only add that Yes, I think commercial banks can make smaller investments, and often there are specialized financial institutions that are more targeted to smaller scale investments like MFIs. And Drive, for example, part of what they're doing is lending to financial institutions in counties to make those smaller investments.
Great. I think we have an exciting second half of the webinar coming up for you soon, getting into the practicalities of applying for some of the finance opportunities that were highlighted in the report. Just before we hand over to that, there's a lot of interest in seeing the recording of this webinar for people who are joining us from the road to see the report findings, the PowerPoint deck, question as well around to what extent the database that was developed will be available. So what can we look forward to on that?
We will be sharing a recording of this meeting as well as the presentation. And then you can look for us in about a month or so. We'll be publishing a larger report that will include more of the data from the database. And we now are connected with all of you. And so we will also, when that becomes available, share that as well.
Great. So thanks, Christina and Arjun, for that presentation.